Good evening. Today we will be looking at chapter 1 and then moving from there we will discuss the other chapter. Chapter 1, it's about your first, in the study pack, your first topic. It's about objectives of the organization or companies. Objectives of the companies. I'm sure like all know that every company exists in business to achieve their objectives. So when you see their objectives, I would like to put it into a concept of primary and secondary, the objectives. So what is the primary objective of any organization? Primary objective. You might have thought the company main objective is to make profits, profit maximization or making profits. But in today's context or even earlier, if you really look at the objective, it's not the profit. The organization exists to make or create or maximize shareholders' wealth. So this is the primary objective. Primary objective of any organization is to achieve the maximization of shareholder wealth. So your organization, whatever the business it is, it will try to achieve this maximization objective of the resources. Secondary objective, you might say, all the other financial targets, we call it sometimes, all financial objectives, which all fall into secondary objectives, which could be your normal, say, profit before tax of say 1 billion rupees, 1 billion rupees or 1 billion. And you might say that your company would like to have gearing ratio. Your company want to have a gearing ratio of say 40%, not more than that. And you might say that your cash flows, your company's cash flow to be say X amount. You would have objective to say achieving the cash flow of X amount annually. And you could say that earning per share, our company earning per share should be 100 rupees. So these are some of the examples. It could be any profit related, earning or gearing related or cash flow related or earnings related. It can be any of these. You have a specified value where you would like to achieve for a year and in the future. So these are financial objective or financial target most of the time. But primarily the organization exists to achieve or maximizing the shareholder wealth. So all the companies would be working for this. Now the question comes, what is this profit maximization and the wealth maximization? Profit maximization is something about short-term scenario, short-term your objective. Maximizing wealth is a long-term phenomenon. Wealth is something, your value of resources that you have. So the objective is to increase the value of the resources. So it is a long-term phenomenon and the profit objectives are mainly your short-term. Maybe sometimes you see the companies try to achieve the profit objective, while ignoring or forgetting about the long-term objective of wealth maximization. So one good example is you might sell your property, plant, equipment. To sell the property, plant, equipment which is capable of earning annual return, annual profits or the cash flows. You have a machinery, for example, that machinery is capable of generating income every year from which you can survive and you can grow. But you decide, okay, there is a good price you have got for the plant or machine and you sell that machine on 1 year and make a huge profit for that year. So once you make that profit, that's it. You don't earn from that again and again. Okay, maybe you get the money from the realization and deposit in the bank and you get interest income. But other than that, it doesn't grow. But the plant that you have, the asset, which is capable of generating your output or whatever, that can be generating sales or cash flows future period. So there is a long run, you definitely have an income which is significant rather than you selling it for 1 year purpose and make profit out of it. So short term you might say, okay, I sell this property and make a gain out of it, and my 1 year profit is huge profit. So people will do that, ignoring the primary objective. So the profit objective is, please remember, it's a short term. It will achieve the short term requirements. But the long run, you might ignore, long run purpose you are ignoring. Maybe another example you can think of is, in the profit objective, you can delay the research and development. You can delay the research and development. When you don't incur the research and development cost for any, especially the products company where electronics are concerned, or even some other products where you need innovation regularly, you need research and development. Which means your company needs to incur X amount of money annually in research and development, which will benefit your company on a long run. Why? You will be in surviving, or you would be sustaining your business existence and make money for your shareholder. If you don't do the research and development cost annually, you might be having a good profit for the year. Maybe for example say 100 million your research and development cost per annum. And you might say, okay, we don't want to incur this cost. By not incurring this cost, I am saving 100 million. So my profit goes up by 100 million. That is a profit objective. Why? Short term you decide. But this 100 million, if I don't incur couple of years, what happens? In the long run, maybe 4 years down the road, I may not have business for my products because my products are outdated. Nobody wants to buy my products. Nokia, right? Nokia at that time was the market leader. Everyone uses Nokia phone. But at a point, they lost the market. Why? Even though they had research and development, all that, but there was some reason they have not come up with the innovative product which the market would be requiring at that time. So they lost the market. So the research and development, if you don't do regularly, over time period, people lose the confidence and the people taste changes anyway. So when the people change in their taste, they will decide, I don't buy these goods. I don't buy this product. When you don't buy that product, automatically your business is out. So please note, research and development is a cost. Annually you may have to do, but you might decide to achieve the profit objective not to incur the research and development cost for 1 year or 2 years. So if you don't do that, your profits are very good. You are a very good profit company. But long run, you cannot survive. Why? You don't have business because people need your innovative products. Innovative products are not there in the market. People lose the market. So that's why we have to think profit objective is this kind of things where you will want to achieve profits even at the expense of long-term purpose, which is a maximizing shareholder wealth. Okay, so that's basically your primary objective and secondary objective. Then going on the same topic, these objectives are there for all the stakeholders of the company. What we looked at, primary objective is from shareholder point of view. The shareholders' purpose or the shareholders' objective, primary objective is to maximizing their shareholder wealth. But there are other stakeholders. Who are the other stakeholders? You will see that, say example, employees. In any company, you have employees who are main stakeholder of the company. And then you have management. That is their director board or senior management who are supposed to run the organization or make decisions in the company for the benefit of the shareholder. Then you will have customers. Then you have suppliers. Then you have banks or financial institution, banks or other financial institution. Then you might see there is a stakeholder called government. Then I have shareholder we discussed earlier, primary objective, but shareholder also main stakeholder. Then the government. Then you might have public groups. Public groups, when I say they are the public interested people who are the environmental friendly people, all that are public groups. So you can see these all are stakeholders. These all are stakeholders. All these stakeholders have objectives. So not only the shareholders, all these stakeholders have objectives. So if you have shareholders, primary objective is, we said you will want to get maximizing the wealth, that's your primary objective. At the same time, you would like to get dividend also, annually dividend. Not only you want the share price to go up in the market, you would like to get dividend annually. So dividend and maximizing wealth are the key objectives or key purpose of your shareholders. Employees want their remuneration, or we call it salaries, and other welfare related. And you might say other benefits. So salaries, benefits, welfare, all that employees look for. Management, again they are interested, or the objective could be remuneration, good package or good remuneration. And they are sometimes interested in the profit sharing. Then customers always want good quality product. And accessible. They want access to their products and services, and they want the goods at reasonable price, fair price. I don't say cheap price. They want a fair price goods. People don't really want it at everything at cheap. Even though psychologically we say their products needs to be cheaper, but people are willing to buy at a reasonable quality with a reasonable price. Suppliers, they always want your relationship, and they want the payment on time. Supplier's point of view, he would like to maintain relationship with the company continuously. They don't want to say that I want to work with you for 1 year, after that I cut your relationship. No. Suppliers always like to be with you for a longer period. They want you also be there, I also be there, so we both grow. Suppliers' objective. And payment on time. Definitely they want the payments on time. Banks and financial institutions, I would say similar to suppliers, they also want payments on time, capital and interest both. And the relationship. They would like to maintain a relationship with you continuously, so that we also grow, they also grow. Government, as we all know, that it's taxes, and you will have employment. Government objective from the company is employment to be provided by the company and taxes to be paid. Public groups, they are mainly interested about the environmental related and more ethical businesses. These are their expectation from the company. So please note, there are various stakeholders in any company. Each of these stakeholders have their objectives. All the stakeholders have their objectives. I just mentioned 2 objectives for each person, but it can be more than 2. So each one has an objective. He wants to get that something from the company. So these are some of the objectives. Now the question is, are these objectives on the same line or some same direction? To be honest, no. If you say the employees, what the employees want, you and me, all of us want good salaries. We always like to get good salaries and would like to get all the welfare related activities, all the services or whatever benefits. And the other packages, bonuses, medical insurance, right? And you might be wanting vehicle allowances, and then certain trips outside the country, and you might be willing to get training every year. All these are your employees' expectations. So every employee annually expect these things, not that they don't want it. When you go to give all these expected objectives of the employees, problem is, what happens? Your profit comes down. So your profit is going to come down. So when you are saying that your expenses are going to go up because of somebody, a stakeholder wants it, your profits are going to come down. So since the profits are going to go down, who is going to get affected? Shareholders. Why? Shareholder wants dividend, that means good dividend, and he wants wealth creation. In other words, you need to be profitable regularly. You need to make money, you have to grow, you have to pay dividend, all that shareholder wants it. But employees want all this. So when you go to give employees everything, they will be happy, but shareholders may not be happy. So what is happening? There is a conflict between these two objectives. Similarly, you take any of these people, their objectives are not in the same direction where the shareholders is concerned. Right? One objective will be crashing with another person's objective. So it will disturb the other person's objective. So what do? So there is a understanding that objectives are in conflict. Objectives are in conflict. So please note that objectives are not in one direction, they are in conflict. So what's going to happen? If the objectives are not in one direction and they are in conflict, now you need to decide, how do I balance this? So in financial management, we need to first understand these objectives, and we need to make sure that all these objectives are reasonably balanced. Why I say this reasonably balanced? You cannot satisfy employees all the objectives. If you are going to satisfy all the objectives, shareholders' profits will come down. So shareholders may not be liking it. Similarly, if the customer's objective you are going to achieve by giving the good quality product and accessible every branch, every distribution channel, and the price is lower, then customers will be definitely happy. Why? He is getting the product at a lower price, accessible everywhere, and good quality product. He is very happy, customer. But again, profits will come down for shareholder. So there is always a conflict. So you need to balance. So please understand, when you are having objectives in conflict, you need to balance these objectives in a reasonable manner. So how do I balance these objectives? I need to balance it. So when you are going to balance this, I have to ensure one thing: I cannot ignore any person's objectives here. In the sense, like, you can't totally ignoring an objective of somebody and achieve somebody's objective. You can't do that for a long run. Sometimes you may be lucky to do certain things for a short while. Maybe I think there was a case some time back in a country where the company put up their factory in an old building which is almost to collapse. The building is not so strong, it may collapse anytime. So you are going to put your factory there. So the cost of that building or cost of using that building is very cheap. So your company is very much profitable. Why? You are having a very low cost environment or low cost infrastructure. So the company shareholders are very happy because more profits are coming. Maybe the employees may not be happy because they are not given a good working conditions, so they are not happy. So you are ignoring the reasonable objectives of the employees and you are achieving the shareholders' objective. But what happened? Over a period of time, few years later, that building collapsed. And killing many people in that company or the staff. So the factory workers died. So then finally what happened? The court case, the factory was closed and the owners were arrested. So this is a case in real life, not in Sri Lanka, for other country. So what I am trying to say that it is what will happen if you are going to ignore one of these stakeholders' objectives totally. You will have to balance these objectives. You cannot give a very low quality product to customer and make good margin. You can provide a low quality product so that your margins are very high, right? So shareholders are very happy by good profits. But low quality product you are giving to the customer. Maybe for short run, customers may not be aware of it. Customers are not able to understand this quality. They are just having it, thinking that this is a good quality. But over a period of time, customers will get to know from some source that these are dangerous to their health. So they will be disturbed. At that time, everyone will boycott your products. Nobody will buy the products from you. Same time, your company may not be able to survive or sustain their business hereafter. So your profit objective to achieve, you have gone and ignored the customer's objective. So when you do that, definitely on a long run, your company has to face the music. So please be aware that when the stakeholder objectives are in conflict, we need to balance the objectives. If you don't balance the objectives, we need to face serious consequences in the long run. So these are the knowledge you should have in any business, any industry. These are common, right? So you will have objectives, the objectives are conflict. So how do I balance these objectives for the survival of my company on a long run? That is the primary objective of shareholders, maximize the wealth, maximize the wealth. So it's a long run is the target of surviving. Then moving on, when you say the secondary objectives, I think I mentioned at the beginning, primary objective is wealth maximization, then you have secondary objectives. Under secondary objectives, you can look at the financial and non-financial. What I earlier mentioned is only about the financial, where you are talking about your profit after tax or profit before tax of say 1 billion, and then you have a gearing ratio for 40% maintenance, and your dividend per share say 10 rupees, and your cash flows for the year, net cash flows 1 billion, like that. It's all financial objectives. So this you can have a list and say these are all financial objectives. What is non-financial objective? Your company will have non-financial objective too. What are non-financial? You could talk about staff welfare. Staff welfare. Actually, this is nothing to do with financial. Staff welfare. So your company needs to ensure that staff welfare is looked after. Looked after. It's not about profits. It's not about cash flow. It's about the staff welfare. So each and every employee in the company feels that okay, this company looks after me very well. Not only salary, there are other things they look after. They have given me good working conditions, they have given me an insurance scheme, they are giving certain longer term benefits on a regular basis. All that is available, and I have been given certain times the staff loans and grievances handling. There are people to talk to. So there are various benefits you can be looking after. So staff welfare is non-financial. Then you will have a quality. This quality is a product quality. This is again a non-financial objective. The company may be having a non-financial objective as quality also. Then your company will say, okay, non-financial point of view, the what you call the market share. Market share. How much market share I want to maintain? You might say, okay, I want a market share of 25%. These are called non-financial objective, right? So these few examples, maybe you can go through the study pack on balanced things just to get an idea what are the non-financial objectives. Then there is something called agency problem in financial management. Agency problem. What is this agency problem? Please understand the company, if you take the company, there are people who give money, say the shareholders. So people give the money to the company as shareholders. And the management, there is somebody called management. So the management is what they are doing, they are managing the company. So in a company, you have two people mainly, shareholders and management. Shareholders are the one who are given the money. Management is one who is running the company. They make decisions, they decide on the strategies, and they look after the company, and they involve in the company. And then basically they will work for the company shareholders, and they are creating wealth for shareholders. So this is the normal scenario in any organization. So management is working for the company to achieve the shareholders' objective. Now see what the shareholder wants: good profits, good dividends, good wealth creation. Management want their perks, their remuneration, their packages, their welfare, their growth, all that. Now when you say this management is going to manage the company and shareholders are the final beneficiary of the wealth creation, there could be a problem or the conflict between these two people. Why? The shareholder wants certain things to be done, management will be doing everything for the benefit of somebody, not for them only. They also will benefit, but they think, okay, I can benefit, but same time I am working for somebody, he is benefiting more than what I am benefiting. So what do I do? So there is a problem. Sometimes the management decides, I would like to get more salaries, I would like to take more benefits, I would like to get further benefits in the future. All that management may decide. That will impact the shareholders. So shareholders also will realize that management is not working reasonably or fairly for shareholders. So this is the problem you may have in the organization. So the shareholders have to decide whether you have looked after the management properly. If you don't look after the management, there could be a situation where the management will not work properly for the company. In the sense they don't, with loyalty they don't work, they may do other things for their benefits. So the shareholders will lose. So this is the agency problem the organization could get right most of the time, because there are two people involved here. Somebody is working for somebody's benefit. So they can decide, I may not do that properly. So basically I stop this and I will benefit for myself. So unless the shareholders have control over the management properly, there is a problem. And most of the time the shareholders, if you are in small levels of minority shareholding, you don't have major control over the management. Right? But if you are a major shareholder, you have 51% controlling interest, then you can decide the management, whether they are running it properly or not properly, and make decision, and you can change the management also. But otherwise, you have to live with the management. If the management is good, you are benefited. If the management is not good, you may not be able to do anything because you are a minority shareholder. So please note, this is the agency problem you have to be aware of. Then there are three decisions. The finance function, I would say, makes in a company. Three decisions the finance division or finance function makes in a company. So what are three decisions? One is investment decision. Second one is financing decision. Third one is dividend decision. So please note, these are three decisions. Finance function, it can be starting from the accountant or the account staff to the finance director. Entire finance function makes these three decisions on a regular basis. How frequently you make each of the decisions depends on your organization. Right? Organization, this can vary. But definitely, these three decisions are made in any organization. Only the dividend decision, frequently we can say, example, once or twice. We could easily say that dividend decisions are made once or twice in a year. That is how much of profits you distribute to the shareholders. That is your dividends. That dividend decision you might make once a year or twice a year. You don't really, actually we say interim dividend and final dividend. Most of the company will have only one dividend. That's the final dividend. They don't have interim dividend also. So this is what you make, a decision making, you make in a finance function once or twice. But if you take investment decisions, financing decision, they are not once or twice. In many times you may be making in an organization for 1 year. So what is investment decision? Investment decision is about you investing in an asset or project, even research and development. It can be various things. So investment decision could be falling into asset purchase, project investment or R&D. So it can be various investments. So when you say asset, the asset can be even starting from a laptop and going into a furnitures, vehicles, land and buildings, and a factory and a company. All these investments are falling into investment decision. So the investment decision is all about whether to invest or not invest. Whether to invest or not invest. Financing decision is about how to finance. How to finance. Investment decision is about whether to buy or not. Whether to buy or not. That assets can be, or the investments can be any of these assets, project or R&D. Finance decision is about how to finance. How do you want to finance this? You can be financing any of these investments by shareholders funding. It can be loan funding. Even in the loan you could decide I want to finance through the long-term loans or short-term loans, or I may go for leases. So various financing options you have got for financing decision. So please note, any investment decision you are going to make, right, this can be, we are learning from the corporate world, but this can be applicable even individually or personally, company and country. Any investment decision you are going to make, that investment decision results in a financing decision. We all have to understand that. If I decide, okay, I want to buy a house or maybe a land. If I want to buy a land, that's my investment decision, whether to buy or not. So I decide, okay, I will buy the land of say 1 million or 5 million rupees worth of land. That's a good thing you are making. But that land buying decision, once you make, that will push you to decide how to finance. Am I going to borrow money and buy that 5 million? Or am I going to raise money for my company and buy the land? Or might be I looking at the other option of financing. So please note, the investment decision results in financing decision also. So compared to dividend decision, investment decision and finance decision is more often you do that. If the frequency of decision making is not once or twice, many times you make investment decisions and financing decision. So please note, our syllabus, we will look at many areas, many learnings, but all these three decisions fall into those topics. So everywhere you will be doing either investment decision or financing decision or dividend decision. So keep in mind that any organization, the finance function involves in these three decision making. How frequently you make depends on the organization, but you are making the decision. You are making the decision. Then these three decisions that we are talking, question is, are they linked? Are they linked? In the other sense, whether there is a relationship, interrelationship between investment, financing and dividend. Do we have? Question is whether we have a interrelationship between these three decisions. The answer is yes. Investment decision, as I mentioned, results in financing decision. I said if you decide to buy land or vehicle or any asset, immediately your question comes, how do I finance that? That means you are making this decision and you are resulting into this financing. So it's a link. Then if you decide on how much the dividend to be paid, if you say 100 million my profit after tax, 100 million profit after tax, and dividend 100 million profit, dividend 60 million, then you are left with 40 million. This is your retention. 100 million profit, dividend 60 million, retention 40 million. So here, when I go to retain say 40 million, what I am going to do? I will retain for my business or investment purposes. So I am going to retain money for my investment purpose. So dividend decision will basically impact my financing decision of the future. Financing decision of the future. If I make or if I pay 100% dividend from the profits, 100 million I pay out to the shareholders, I don't retain anything. So when you come to next time investment purposes, I have to find new money. I don't have any money in my company because I don't have any retention. So please understand that dividend decision making have an impact on financing decision. Similarly, your investment decision on a long run impact your dividend decision. Why? Why do you invest? Why any shareholder wants to invest in the company? Why the company has to invest in business? Why they want to buy new plant? Why they have to buy new factory, new company, new assets? Why do they invest? Why do they open up showrooms? All that why? The simple reason is to make money, to earn more and grow more, expansion. So the investment decision results in expansion, growing profits, growing dividends, all that. So my dividend will be growing in the future. So if I invest new plant this year, maybe 2-3 years down the road, I will be able to pay more dividends. So please note, each of these shows the interlinkage between the three decision making. Right? The examiner had been asking once or twice how these are linked, investment financing division. So please note that these are interlinked. So you need to be very clear. Investment decision, when I make a decision to buy a land, impact my financing decision because I have to make a decision how to finance that investment. Dividend decision will decide my retention. That retention will be deciding my future financing. If I want to invest in a new project, how do I finance? If I don't have any retention, I have to go for a borrowing or new share capital. So that is second. Third, investment decision today, what I make today, definitely have an impact on a long run my dividends or profitability. Profitability will link to the dividends, so there is impact of investment to dividends. So these are the linkages between three decision making. Then we look at the chapter 2. Chapter 2, we quickly run through that. Chapter 2 in your study pack. Please look at the chapter 2. It's about the capital formation, how the capital is getting formed. Capital is formed generally from the savings. So anybody starts saving some money will be able to saving continuously will result in investments. So please note that the habit of saving in any organization, you retain some money and keep it for purpose of future investments. So the capital formation takes place in an organization by retaining profits, retaining money for the organization growth over the period of time. So this can be applicable not only in the organization, even in the country where the saving habit starts, more and more saving. People starting saving, after saving comes to be large amounts that will convert it to the investments. So that's how the investment takes place. Then the other slight area is the sources of finance. I think last class we touched upon it, sources of finance. I quickly run through it. Sources of finance, you will see that short term and long term. So you have long term sources, we looked at that the class. Long term sources, you will have the shareholder funds, where you can be talking about new share issue, or right issue. Please understand, the shareholder funds, you can go for a new share issue or right issue. Right issue is the new shares you are issuing to shareholders, that is existing shareholders. You are issuing shares on the proportion of their shareholding at a price below their market price. Below the market price, you issue shares to the existing shareholder in the proportion of their shareholding. This is right issue. New share is totally you are issuing shares to the public, so public will be buying the shares. So this is the public issue. This is actually the to the existing shareholders issue. The shareholder funds can have retained earning. Whatever the profits you have not distributed to shareholders will be there in your organization. Please be aware, this is the easiest source of fund in any organization. Why? This is the amount of money you have really made in the company as the profits, and you have not distributed to shareholder. So anytime if you want to use it for your investment, you can take it, you don't have to ask anybody. But if you are going for a new share issue, it's a big process. You have to be preparing prospectus, and you have to ensure that all the requirements are fulfilled, and then you have to convince the shareholders to invest. Second, right issue. Again, even though they are issuing the existing shareholders, you have to convince the shareholders whether the monies what you are going to take are going to be used on good purposes, and you are going to grow more, and your profits are going to be more. You have to convince the existing shareholders to get the right issue done. But the retained earning is something where you are keeping the money of the shareholders as the profits. You can use it for your business purposes. So please note that these are the shareholder funds, long-term source of finance. Then we talked about earlier class a long-term debt. Long-term debt, where I can remember we talking about corporate bonds or debentures or long-term loans. So please note, it can be a debt, debentures and long-term loans. Then you might talk about preference shares. So there are shareholder funds, that is ordinary shareholder funds, long-term debt, which can be debentures, long-term loans, and preference shares. These are the long-term sources of finance any company could have. Short-term, you might see that bank overdraft. The organization has bank overdraft. For running purposes, for working capital management purposes, you borrow bank overdraft. And short-term loan, you can take a short-term loans. Then you might go for leasing. Right? It's actually a short-term source, right? Because you are not dependent on long-term. You may decide that in between I don't want to continue, so that's short-term purposes, right? Short leases. Then you will see that even the trade credit, supplier credit, your supplier credit is a short-term. Why? Most of the time we don't realize that the credit period granted by our supplier is a big source of finance. If you don't have any credit from supplier, all the money you collect from debtors, you have to pay immediately. Or even if you don't collect from debtors, cash you have to pay the supplier. But supplier credit you have, even if you are given credit for 2 months to the debtors, and if your supplier given 1 month credit, you have some credit period you can breathe to pay your supplier. If you don't have supplier credit, you are under pressure to pay your supplier on a regular basis to get the products from them. So please note, this is an important source of finance. Even the short-term nature, this is something needed. So these are, just to get an idea, long-term sources and short-term. You might look at the study pack for better understanding of the wordings. Then there is something called role of treasurer comparing with the role of financial controller. So what is role of treasurer? Treasurer is somebody who manages the treasury, or in other words, the functions of treasury is managed by a treasurer. So most of the time what you are doing here, you invest monies, your excess monies. Similarly, you borrow money, You borrow money when there is a need for money, you will borrow money and you manage that money. So, but basically you are doing, you are managing the funds, investing, borrowing and managing. This is basically the treasurer's main role. It includes various activities also, right? You deciding how long I am going to invest, my duration of investment, and what is the rate of interest I am going to invest at, and what are the instruments I am going to invest at. Similarly, if I am going to borrow, how long I am going to borrow, at what rate I am going to borrow, what currency I am going to borrow, what banks or what institution, what financial instruments I am going to borrow at, all that will be looked after by the treasurer. So, please know the treasurer functions talks about investments and borrowing and managing. So, when you say the investment, it can be the, you need to look at or the factors like time period, how long, then instruments, where I am going to invest, instruments, and the return and the risk and liquidity. All these factors we have to consider when you are making investment. Borrowing, again, time period, rate, security, and our gearing position of the company. So, these are some of the things you will consider when you are going to borrow. Managing involves all these activities in a proper financial management purposes, you manage that. So, these are roles of the treasurer. You will see in the organization, you might refer in the study pack, right. It includes, the managing includes your liquidity management, because each day you have to ensure that your company will not get into a serious liquidity problem. So, that basically involves your treasury has to be functioning properly. Anytime the organization needs cash, you should be able to raise money and pump the organization. Similarly, if you have excess money, you don't need that money for another 1 or 2 months, how do you make sure that those excess money will earn return for the organization? So, these all functions is the treasurer's role. So, treasurer's role, various other things also some of the organization include, right, even the tax related activity of these investments have to be managed by the treasurer, and then including the system related activities, right. You may have a good system to manage this treasury function, all that will be falling under treasurer role, but these are dealing with your funds or money. Then we have another role of financial controller. So, please note, this is actually more of a regular finance function activity. You being a financial controller, you have to ensure that your accounts are properly recorded, or bookkeeping, accounts preparation and bookkeeping job is done in the organization, and you prepare the management accounts for the decision making, and then you will look after the taxation activities, taxation planning, all that, and your compliance role, and then you will have to decide as a financial controller even the risk relating to your function, how do you manage those risks. So, please note, these are some of the roles: bookkeeping, accounts maintenance, management accounts and taxation, and even the cash flow management. It may be overlapping with the treasurer role, but some organizations, the financial control looks after the cash flow management. So, the compliance, risk management, certain areas, all that fall into financial control. So, please note, these are the key activities or roles the financial controller and the treasurer does in organization. Some organization may not have different names, they will have one person who may be the CFO or the financial controller or the treasurer or the accountant, they may have different names, depends on the size of the organization. He will be more or less do every activity of here what you are talking. So please be aware, in a large organization you can have a treasury function separately and a financial function separately. So some company the treasury reported to financial control, right? So some places it is separately the financial controller treasurer both report to CFO then. So please note these are some of the activities of different people. I think maybe here you have to say the normally in the financial controller one of the other activities is the management of working capital. Management of working capital. I mentioned the cash flow management, but even the working capital management is also financial controller does. When I say working capital, it can be inventory, it can be debtors, it can be creditors, all that. So all the credit period policies, all you could be managing as a financial controller. So please understand these are different functions. It may be theoretical very much, but you have to be aware as a function of the organization who does what. Okay. So in the chapter 2, we will continue on the performance analysis. So what is performance analysis? This topic is more useful when it comes to the case study, the 50 marks question, where your case needs to be analyzed. Case needs to be analyzed. So when the case to be analyzed, when you analyzing mean you need some tool to analyze. So one of the tool in financial management we use is the ratio analysis. So that's what we are going to learn, we are going to look at it now. So the performance analysis, you would like to know how the company has performed, So each company financial statements reflect that performance, right? P&L or the income statement and the balance sheet will show you how the company performance and the financial position is. But still that information alone cannot be guiding you how the company really performed. So what do? We may have to calculate ratios. Various ratios we will take one by one. Various ratios, those ratios will tell how the organization perform, in what area they are good, what area they are weak. All this information can be gathered from this ratio calculation. Please note, when you are going to calculate ratios, maybe you have studied these ratios in accounts, in business level or even previous stages. All these ratios, the objective is to get an understanding of the organization in terms of various area. And the ratios when you calculate, you need to make sure you are maintaining consistency in your calculation. What do you mean by that? If I say I calculate, for example, debtors collection period. When I call the debtors collection period, the formula will say average debtors into 365 divided by credit sales. This is the ratio. So this debtors collection period is average debtors into 365, credit sales. But these average debtors mean opening and closing debtors both add together, divided by 2 is average debtors. If we are going to calculate the ratio for 2019 and 2020 March, you may decide to calculate the debtor collection period using average debtors for 2020. You are using average debtors to calculate debtors collection period for 2020. 2090, you use the closing debtors. You would use the closing debtors to calculate the 2019 debtors collection period. Now what is the problem? Both are debtors collection period. But you used year average debtor, that means 2 years opening and closing you take and divide by 2, and you take the closing debtors for 2019, which is not acceptable in ratio analysis. It means you are not maintaining consistency. So please be aware, whenever we calculate any ratio, same formula, same way of calculation has to be maintained for the different periods. You cannot use one calculation in different manner to another year calculation. So if you are using closing data year, you should use closing data year. If you are using average data, you should use average data. So you need to be very clear in this ratio. It can be any ratios. If you are going to calculate certain industries ratios, you might calculate 1 year in one manner, another year another manner, which is not acceptable. Same way you have to calculate both years. Otherwise, that ratio comparison cannot be done or it's not meaningful. So please make sure that you use the same denominator and numerator basis to calculate ratios for a period or different periods. So this consistency is very important for ratio calculation. Then when we are going to calculate ratios, why we are calculating ratios? It's like a medical doctor takes he looks at the patient by taking various reports and say that how his health condition is. So in order to decide the health condition of the person, he does many reports or many various reports and various scanning, all that he takes it and decide how he is. Similarly, financial statements, when you take the ratio analysis is a tool which basically help you to identify how the company's financial position, how the financial healthiness of the company. So please note the ratios will be playing a major role in understanding the financial health of any organization. Then the ratios, when you compute, we need to compare. So with what we are going to compare? You have one, comparing the ratios between the periods. So it means you are comparing with previous years. Your ratios for the current year, you compare with previous year and current year. Previous year and current year, you compare the ratio. Second, you can calculate the ratios. You can calculate ratios for different industry companies. You compare your company information, compare with industry information. You calculate the ratio for your company and compare with the industry company. If you take commercial bank ratio, you compare with Sampath Bank, HNB, Ceylon, you will compare the industry company and see how you have performed. So the industry comparison. Third, you might calculate ratios and compare with budget. Because in most of the time, the organization will have budgeted ratios. When they are planning the next year performance, they have calculated budgeted. They want to maintain GP margin 30%. They want to maintain liquidity ratio 1.5 into 1. They want to maintain gearing of 40%. These can be their budgeted or forecast. You compare that with actual and see how you have performed. So please be aware, these are the three comparisons you can make. One is previous years. You compare the last couple of years, your current year ratios with the last couple of years and see how you have performed over the period. You might compare with the industry company. Various industry company you can compare. Third, you can compare with the budget. How your company performed according to the budget or not according to budget. So these are the ratios, whatever we calculate, we are going to compare with one of these. Sometimes you are available with information, you can compare with all three, or sometimes you will only compare with budget or the previous year. So depends on that, we will come to later. So these are the comparisons you may make. When you go to calculate ratios, you will see there are limitations. We have to be aware of this limitation. Always when we calculate ratios, we need to know the limitation of the ratios. We don't blindly take the ratios and say this is how the company is, how this company performed like this. No. You may have to know how this limitation disturbs your company performance. So what are the limitations? Say for example, the information unavailable. You will see that information is unavailable. What do you mean by unavailable? When you want to compare with the industry some of the ratios, you don't have an industry company, or you don't have access to the industry company information. Maybe say you are a company manufacturing water bottles. Your water bottle manufacturing company information, you have a need to compare with another water bottle manufacturing company. So if the water bottle manufacturing company listed in stock market, you can get the annual report and financials and compare with your performance. But if it is not listed in the market, it's all private companies, you don't have access to the private company information. So how do I compare? So please note that there may be situations where you don't have information unavailable for the manufacturing or whatever the product companies. So those times you have to be knowing that your ratio, your company ratio, you don't have a way to compare with somebody and say your company has performed better, or they can perform better. All that can be decided if you have information. If you don't have, there is a limitation you have. Second, accounting policies. Please note that most of the time we calculate ratios based on accounts, financial statements. The financial statement of each company is subject to their accounting policies. So if there is a variation between the accounting policy between companies, your ratios may not be showing the same thing. One company may be accounting or their impairment practices could be different to your other company impairment. Or one company may be going on the revaluation model. Some company must be going on the cost model. So if you have different accounting policies, you will realize that your ratios also will differ one company to the other. Or even the investment categories. If you take investment category, one company investments are counted on the AFS basis, available for sale. So that means your fair value changes are only in the reserves. But you might have another company, same industry, having the financial assets, investments are in the fair value through P&L, which means their gain or losses will be affecting your P&L. So your profits are reflected with the fair value through P&L effect, but the other company which is valued the investments under AFS category, where the gains or losses are in your reserve, it's not in your P&L. So the performance of two companies cannot be compared. So please be aware that accounting policies differences will be affecting your company performance, or it will not reflect the same picture. Third, you will see that you may be calculating some ratios as at one point of time, as at a date. For example, 31st March you calculate company financial ratio, but that day you might see your balance has gone up for some reason. Say inventory. If you have bought the goods on 30th of March, then your inventory is very large. Whereas your 365 days, if you take that kind of inventory, you don't maintain. You are maintaining only that day because the inventory goods have come only that day, so your 31st March inventory is very high. But other days, you don't have that kind of inventory. So please note whether your ratios reflect throughout. So limitation is it's not representative. It's not representative. Your values in your balance sheet is not representative of 365 days. It may be only one day you have a larger balance in your inventories or debtors for that matter. If 365 you don't have average balance of something like that. So then that can't be calculated for your ratio computation. Then people can manipulate. People can manipulate financials, which mean your ratios can be not proper. The manipulations could be affecting your ratios. So please be aware that there is a limitation. Fifth one, interpretation issues. Sometimes you will realize that even though you calculate ratios, the interpretation can be wrong. people will calculate ratios and interpret it wrongly, whereas the real meaning can be different. So these are the few of the limitations whenever we go to calculate ratios. Please be aware, before we use ratios for our decision making, we should be knowing that these are practical issues. One, information unavailable, right? A e-channeling company cannot be comparing another e-channeling company because there may not be listed e-channeling companies. So how do we compare? So information is not available. Accounting policy difference, as I mentioned, that how your investments are categorized. And your balance sheet figures may not be representing the average balance of the 365 days. Fourth, manipulation. You purposely manipulate accounts, then your ratios will be wrong. Fifth, interpretation. Even if you calculate ratio, if people start interpreting wrongly or differently, your meaning is gone from the ratios. So these are the few of the limitations which we have to be knowing whenever we are going to use ratios. Then we look at what are ratios we are talking. Ratios we are going to talk. First one, profitability related. Profitability related. Profitability related ratios. We have to be knowing profit is a word which has different shades. You can start from gross profit, you can go to the operating profit, you can go to net profit, and you can go to the profit after tax and profit attributable to ordinary shareholders. So you can have various profits. So we will have to calculate ratios which will reflect certain information to the organization or reader or investors. So profitability ratios, we could think about GP margin, operating profit margin, and your sales margin. So these all three, we might say, all margin related. When you say margin, these all depend on sales. So you are talking about GP divided by sales, operating profit divided by sales, sales net profit margin. Okay. So you can have GP divided by sales, operating profit divided by sales, net profit divided by sales. All three gives you margin. GP margin, operating profit margin, net profit margin. So this will reflect that out of sales, what is the margin you have in terms of GP, in terms of operating profit, in terms of net profit. So this is one. Second, you can compare your return or the profit, that is EBIT divided by total assets. This is your return on assets. Return on assets. EBIT divided by total assets, this can be return on assets. Same times you can calculate EBIT divided by capital employed, same thing, return on assets. So please be aware that this is out of your total assets invested, how much your EBIT is. EBIT means earning before interest taxation. Earning before interest taxation. So this is before deducting your finance cost, how much your operating profit, for your total assets invested. That gives you return on assets. Third, you will have return on equity. Return on equity. This is actually, from shareholder point of view, profit after tax divided by equity. Profit after tax divided by equity. So you can see that these all profitability ratios. Actually the return on equity is more relevant to shareholders' perspective. So if you are going to calculate investor related ratio or shareholder perspective ratio, return on equity is definitely there. Others are mainly the profitability ratio. Others are mainly onto the profitability ratio. So in your going to case study questions, you will be calculating these ratios to reflect or understand how the margins are maintained in the company, how the return on assets are, how the shareholder returns are in the company. This you can calculate, as I mentioned earlier, you can calculate for 1 year compared with previous year. Or you can calculate for 1 year compared with industry company ratios. Or you can calculate for 1 year and compare with budget. So please note that these ratios can be calculated for the current year and previous years also, or industry or budget in this manner. So that will reflect your profitability of the company. This will reflect from shareholders' point of view. Then the second ratio, you will see that it's about your liquidity ratio. Second ratio is liquidity ratio. First one we talked about profitability. Second one you can say it's your liquidity ratios. So what is liquidity ratio? Mainly the liquidity ratios are current ratio, other one is quick ratio. Current ratio is current assets is to current liability, quick ratio is current ratio asset minus inventory is to current liability. Now these two ratios mainly, they basically tell us how liquid your company is. How liquid means whether your company is able to meet, whether your company is able to meet day-to-day commitments, day-to-day liabilities. So please make sure you are very clear in this, because liquidity ratio is the key for any organization survival. First of all, you need to make sure that day-to-day my commitments are met. If I can't meet my day-to-day payments, I cannot survive. I cannot go long run. I have to close my company. Even though I may be making losses, if my liquidity is very good, I can still manage my company. But if my profits are very good, but my liquidity is not there, I cannot run the company. So liquidity ratios will tell us whether your company is able to meet day-to-day commitments. Maybe in business level or previous stages you would have learned current ratio has to be 2:1. Quick ratio has to be 1:1. This is only guidance. Depends on the industry you are in, depends in your structure of your company. You might see that the 2:1 is not needed. Even less than 2:1 you are able to meet. You are able to meet your liabilities day-to-day basis. Similarly, quick ratio you don't need to have 1:1. Sometimes you will be able to manage even less than 1:1. But ideally what we say, or normally in financials, we say that 2:1 is reasonable, 1:1 is reasonable for these two ratios in managing the working capital. So your working capital management would be decided by how your liquidity ratios are. So liquidity ratios is a very important thing, because it will tell you how far you can run, how far you can manage your company. Are you having a serious problem? Because you need to be very clear, even a loss-making company can be surviving for 3 years. But a liquidity problem company cannot survive for even 3 months. Why? If you can't meet your salaries, you can't meet your day-to-day utility bills, and if you can't mean you can't pay your suppliers on time, you can't make your payments to the banks or any other financial institution, how long you can survive? Your employees will not be working in your company for 3 months if you don't pay salaries. Your electricity bills and water bills and current, all the other things, utility bills, if you don't pay on time, people are not going to survive. And if you are not going to pay your suppliers, they are not going to supply second month, third month. So this is what the present problem you will have if you don't meet your liquidity ratio properly. So these ratios are very important than the profitability ratios, because cash flows is very important than profitability. So these ratios, how do you calculate, we have looked at. In addition, even your debtors collection period and inventory holding period will help us to understand the liquidity. if you say your debtors collection period for 2020 is 40 days, whereas 2019 it is 30 days. So if you realize that your debtors collection period has increased from 30 to 40 days, which means your liquidity is not good. Why? You have not collected money from debtors, that means you have difficulty in making your payments. So you will have a difficulty in meeting your payments because you have outstanding debtors more than last year. So 30 days has become 40 days, means you have not collected money from debtors on time, so there is a delay. Inventory holding period, similarly you can say for example 30 days and last year 20 days, which means you are keeping your inventory longer period than last year. It means it takes 30 days to convert your inventory to sales. Your inventory to convert into sales, it takes 30 days. Last year, your inventory to convert into sales, it takes 20 days. So you are holding on to the inventory. You have invested in inventory longer than last year. Similarly, debtors, you have invested longer, that means your monies are tied up. So please note that these two ratios also give indication about your liquidity problem. While we are discussing the liquidity ratios, you having a shortage of liquidity and excess liquidity. Sometimes your company will have 3:1. 3:1 means you have enough liquidity, enough working capital to meet your liabilities. Shortage of liquidity means you don't have sufficient liquidity to meet your day-to-day commitments. So you don't have 1 rupee to pay 1 rupee liability. To pay 1 rupee liability, your normal commitments, you don't have even 1 rupee. You have 80 cents. That means you have a serious problem. That is shortage of liquidity. Excess liquidity is to pay 1 rupee, you have 3 rupees. So you have enough liquidity. You are in a very, very better wicket. Now tell me, what is the problem? What is the problem of shortage of liquidity, excess liquidity? Shortage of liquidity means you cannot meet day-to-day payments, so it can come to a serious working capital issues, and maybe your company can be forced for liquidation. Why? If your company has been dishonoring checks, you are not honoring the checks, you are defaulting the payments, you are not paid people will go for labor, right? And the electricity bills are not paid, then they will cut the electricity. And your banks are not paid, then they go for parate execution. So all that can result into a liquidation. Or suppliers are not paid, they will go to courts. So please note that shortage of liquidity will come to a serious problem called liquidation. Whereas excess liquidity, it's not going to result into liquidation or bankruptcy or any serious problem, but your profitability will be lower. That means shareholders' point of view, your returns are going to be low. Shareholders will have a lower returns. So shareholders will see, okay, this company have enough working capital, but my monies are tied up unnecessarily. Right? To pay 1 rupee liability, you have 3 rupee of assets. You have enough inventory, you have enough debtors you are given, you have enough bank balances. All that will result into my profitability coming down. Why? I am holding something which is not required, and there is a holding cost which will reduce my profitability. So please note, this excess liquidity is there. Shortage of liquidity is where you have a serious problem, you cannot meet your liabilities, it can force to liquidation. So please be careful. When you see that company have shortage of liquidity, it is a serious problem compared to excess liquidity. Why? Excess liquidity problem is only lesser profitability. But if you don't have money to survive, that means you are going to be in trouble. You can't sustain for longer. So very important, even a loss-making company can survive for a couple of years, but liquidity problem company cannot sustain for a longer period. A loss-making company, you can survive. Why? As soon as you get cash from somewhere, you can try. You might have seen some of the government institutions, they are loss-making. They are surviving. Why? Treasury will be pumping money to them. So as far as they get money for pumping money for a company's operation, they pay salaries, they pay electricity bill or everything they pay, and they run the organization even at a loss. How they manage it? Somebody is funding cash. So as far as you are having cash, even a loss-making company can run. But on the other hand, you have profitable company but no cash. Accounting standard may recognize you revenue and you have recognized revenue. So your profits are there, but your cash is tied up in debtors. Debtors have not paid the money. So what happens? You are having a serious liquidity problem and you may have to face that music. So please understand the liquidity ratios is very important, that show you whether you have a serious problem or whether you are manageable problem. Excess liquidity can be manageable, serious problem is shortage of liquidity. And the other thing, when you say excess liquidity, you can call it, it's over capitalized company. Over capitalized company. Generally the over capitalized company is having excess liquidity. That is, excess liquidity is only over capitalized. Shortage of liquidity means most of the time the company which have over trading nature. Over trading nature as the resulting factor is shortage of liquidity. What is over trading? The turnover of the company is growing faster, or the revenue is growing faster, revenue is growing faster without having sufficient long-term capital. Please note, revenue is growing faster without having sufficient long-term capital. If your company has been growing last 3 years, for example, at 25% growth rate, revenue growing at 25%, very good growth, you are very good sales happening. But in order to sustain that growth, you have to be investing in the company. So which means, for example, you want more sales next year, expansion, what has to be done? You have to invest in your inventories, you have to invest in your debtors, you have to invest in buildings, you have to invest in people, you have to invest in furniture, fittings, showrooms, branches, all have to be done. So those are all investments. So these investments are what nature? Short term, long term. If you really look at, all these investments are long term nature. If you are a growing company, always these are long term investments. If you are going to make a long term investments, what is the financing? Long term investments are long term investments. Long term investments are financed to be by long term finance. All long term investment needs long term financing. You cannot finance the long term investment with short term capital. If you do that, that's called overtrading. If you are financing your long term assets with short term capital, then you are overtrading. That's what we are trying to say. Revenue growing faster without having sufficient long term capital. If you don't have it, you are having overtrading problem. So overtrading problem companies will result in liquidity problem. Now please be aware, if you take accounts of a company or you work for that company and your company sales are growing faster. So when the sales are growing faster, don't conclude saying the company is overtrading. That's not the answer. Sales are growing is a good thing. Why? More sales, more profits. Good for company. What is the problem? You are doing sales faster, but you don't have sufficient long-term capital to sustain that sales. In order to increase more and more sales, you have to invest in many things I mentioned. Fixed assets, your furniture, building, staff, inventory, debtors, all you have to invest. These are all long-term investment. In order to invest long-term, you need to finance through long-term. If you don't have long-term financing, you are getting into overtrading problem. If you have overtrading problem you have in the company, you are resulting in liquidity problem. So please be understanding, I am just combining many of the theoretical area, right? Overtrading will be resulting in liquidity problem. Overcapitalization is excess liquidity which disturbs your profitability. Okay? So this is about the liquidity ratios. Then the other thing, other main ratio, third ratio, is a gearing ratio. Third ratio is gearing ratio. What is gearing ratio? I think previous session I touched upon gearing ratio. It's your debt capital, long-term debt divided by long-term debt plus equity into 100. Debt divided by equity. Debt divided by debt plus equity. So this is the gearing ratio. So this basically tells how much of your assets have been financed by debt capital compared to total capital. So are you depending on debt or less dependent on debt? So if you have 51% of debt financing out of total equity or total capital of your company, you are high geared company. If it is less than, it is more than 51 or more than 50, you can say more than 50, it's high geared company, less than 50, it's a low geared company. So the gearing is calculated long term nature debt divided by long term debt plus equity, that gives you gearing ratio. Same time you can see interest cover. This basically your EBIT divided by I. This shows how many times of interest you have made profit in the company. In other words, are you reasonably able to meet your interest commitment? So this will show you interest cover. This also reflects the gearing or dependence on the debt capital. So please be aware, these are the ratios, right? The study pack has other versions of gearing ratio also, but this is more common, that is debt divided by debt plus equity. Sometimes you might be calculating debt divided by equity, debt equity ratio, that also shows the gearing. So this gives the idea whether you are a highly borrowed company or less borrowed company. Okay. The last one, I think I touched upon it already, that's your shareholder investment ratio, shareholders, fourth one, shareholders investment ratios. That is mainly the return on equity. Shareholder point of view, he wants to know profit after tax divided by equity into 100. So ROE, return on equity, will show you whether shareholders' returns are sufficient or not sufficient. So this gives you a number which will say that whether company has managed to earn reasonable return for shareholder. Please note, all these ratios gives different ways of or different things about a company. We have to analyze that for the company with compare it to the industry, compared to the previous year or the budget, depends on what the information available. And then they see whether company has performed well compared to last year or performed lesser than last year. So these ratios what we have talked about earlier, profitability, liquidity, gearing and the shareholder ratio. Each company we can calculate and compare with the previous year or with the industry company. Ideally, your industry company needs to be a same size level. If you are going to take a very large company and compare with a small company, these ratios may not be right. Why? Larger company would be able to control costs, so their margins could be very high compared to the smaller company. Because smaller company cost structure could be very high because still they are not got the volumes according to their structure. But larger company, maybe the fixed cost is common, so the volume can be higher, then the margins can be higher. So it depends on the organization size. So it's better always you compare the similar size industry company, your ratios, and then come to conclusion whether your company is having a problem or whether your company have to improve, whether your company performing better than the industry company. Okay. Similarly, you have to compare with the previous years and see how your performance has changed compared to previous year. So these are the few things whenever we calculate ratios we have to keep in mind. As I mentioned to you, the ratio analysis is a very important tool in understanding the performance of the company and the financial position of the company. On the similar area, I would like to say your assets or investments needs to be financed on the same period length. If you say your assets and investments is short term, your financing has to be short term. If your assets and investments are long term, your financing has to be long term. You need to be very, very, very clear. This financing matching has to be done. Short term assets should be financed by short term, long term assets should be financed by long term. For example, if you are buying a PPE or say property, simply you take property. The property of the company, if you are financing, this is a long term asset, long term assets or investment. How do you finance this? It's a long term asset. It's a property, a land or building or whatever property. This property is a long term asset, we all know that. How do you finance? You need to finance by long term financing. Long term financing. So, what is long term financing? Example, either you put your shareholders money or take a long term loan. Long term loan. You should not be buying a property, a land and building with a short term loan, 3 months loan. Don't ever think of doing that. What is the problem? 3 months loan, if you take and buy a property, 3 months down the road, bank will call and say, can you make the payment? And how do you make the payment? Your money is in the property. Unless you sell the property, you can't pay the loan. So, you cannot buy a long term asset with a short term financing. If you do that, you will be forced to sell the property. It's a learning you should be having, not only from company or exam point of view, your personal life also. You plan to buy a house. You want to build a land, you buy a land and build a house. If you are going to do that, how do you finance? Are you going to borrow for 3 months or 1 year loan and buy the house or build a house? No. You need to take a long term loan. Ideally in Sri Lanka, you have a 10 to 15 years loan available in all the places. You can borrow money for 10-15 years and buy the property. That is the financial management. If anybody is doing property buying with short term loan, 1 year loan, that means he doesn't understand financial management. Short term. For example, you are going to buy a short term assets. It could be say even inventory or short term inventory you are going to buy, short term inventory. Only you need it for 3 months. How do you finance? Bank overdraft. Bank overdraft. You can buy the inventory short term, finance by bank overdraft. You don't need a long term funding for this purpose. You need only for 3 months, borrow for 3 months. But if you need it for longer period inventory, permanent inventory, that means every year you have the inventory and every year you are growing, which means you can't take the inventory back to cash. Even though you sell, again you buy inventory. That means your inventory is needed all the long time. In that case, again you need the long term financing. But if you are taking the seasonal reason, April and December in Sri Lanka, April and December is seasonal period. We all know that April and December is having more sales for most of the products. So if you are talking about those products, if you want to buy inventory, you can increase the inventory short term. Only for 3 months you need that inventory. That inventory you can finance by bank overdraft. You don't need long term loan. You don't need long term loan. You can live with short term. So please be aware, short term assets or investments to be financed by short term, long term needs to be financed by long term. Generally, companies try to do this, but you don't 100% match short term with short term, 100% with long term, but you will be able to reasonably you could do that. If you don't do that properly, you will get into issue. And if I take this working capital which is mainly your inventory, debtors, bank balances and creditors, this is your net working capital. Please note, working capital in your financial statement is a current related or short term or long term. Immediate answer you will have is what? Short term. Why? Accounts show it's a current asset, current liability. It's within 1 year. It converts in 1 year. Short term asset, short term liability. Financial management point of view, this is not short term. This is most of the time long term. Why do I say most of the time? There is a component of your working capital which can be short term nature. But most of your component of your working capital long term nature. What do you mean by long term nature? Inventory. You have invested in inventory. This inventory, when do you recover? You will say 2 months time, 1 month time, 3 months time, I convert the inventory into cash. True, you are converting. Converted inventory to cash, are you reinvesting? Yeah, I am repurchasing the goods. Again I buy, again I sell. So if you take the year on year basis, year 1, year 2, year 3 like that, your inventory, what had happened? 10 million inventory, 11 million inventory, 12 million inventory, like that goes. Which means the amount of money inventory you have invested in year 1, when are you going to take this money back as an investor? I take the investor money and invest in inventory. When do I take this money back? When? Within 1 month? 2 months? No. Till you run the company for infinite, that point. Or if you are closing the company at this point, say winding up, at that point you can take the inventory. If you can recall your investment appraisal knowledge, whatever level you have studied investment appraisal, working capital investment, which year cash flow? Working capital investment, year 0 cash outflow. When do you recover this investment? If you really recall, it's your, if you take 10-year period project, 10th year, your working capital investment, say 10 million minus, you recover 10 million year 10. So this is the logic of your working capital is a long term. Inventory, debtors, bank, creditors, all net working capital. But you invest in the organization, it's the invested in year 0, you might invest in year 0, you take it back only at the infinite period or at winding up. You cannot take any time in between. If you are taking your company growing, not growing up, growing down. But there is a component of your working capital, which can be short term nature. What is that? You have your April, December season, for example. That 2 months, most of the organization buy more goods and keep it. Why? There are more sales happening. That inventory for short term. They don't keep that inventory for 12 months. They only have the inventory for maybe another 1 or 2 months. So if you say your company inventory is 10 million, average inventory is 10 million for 12 months, only in April and December, you might have another 2 million. Only in April and December you have another 2 million. This 2 million is permanent working capital or temporary working capital. This 2 million is temporary working capital. It's not needed for long run. It's only for that 2 months. If I buy it in March month, I finalize or settle and realize in my May month, 2 months. After that, I don't need that 2 million investment. I maintain 10 million inventory all the times. Similarly, debtors, bank, all that. That is the seasonal times you might need extra working capital, which is a short term. This is a temporary working capital or variable working capital. Otherwise, most of your net working capital is a permanent nature or long term nature. So please be aware. I am sure like this is the difference to your accounting mindset. Accounting mindset will say working capital means current assets, current liability, it's a short term, which is wrong. Financial management, working capital means is a long term nature other than short term purposes if you are investing on any of the working capital, which is a very short period you really invest, and after that you don't need that. But other working capital, whatever you are doing, like I mentioned, continuously they are till infinite period or at the winding up point. So this is the knowledge you should be carrying from financial management. Working capital is not a short term thing, it's a long term thing. It has a small portion which could be a short term, as I mentioned, seasonal reason you will invest. Okay. So that's basically some additional knowledge on working capital. So this basically covers the working capital slight area I touched upon, but it's mostly the chapter 2 talks about ratio analysis and the other things what we talked about, capital formation, financial controller and treasurer differences. These are mainly to understand some of the basic concepts. Right? I am not doing any numbers questions here, but giving you the idea of these concepts clearly. So please go through the study pack, and you may use the revision kit also to understand some of the areas. Thank you.